Google's dominance in the online search market seems to be at risk, as their market share in this space dropped below 90% for the first time since 2015. In the US, 8% of respondents are now using ChatGPT as their main search engine. This is up considerably from 1% in June 2023. This means that an increasing number of users prefer AI alternatives, which could disrupt Google's business. Investors are therefore reasonably worried of Alphabet's future. But is this justified? After analyzing the worst-case scenario, I believe that the fear is overblown, and this sell-off could be a big opportunity for investors. The rise of AI-powered search competitors. Among the noteworthy developments are SearchGPT, a search prototype being tested by OpenAI, seeks to provide quick, pertinent responses with recognizable sources. It may develop into a strong substitute for Google Search if it becomes freely available. Using their collaboration with OpenAI, Microsoft is increasingly implementing AI into its existing products, especially Copilot, which helps users be more productive while using Word or PowerPoint, could eventually also become the go-to product for user outside of the Microsoft Office products. Perplexity AI, which has just received an investment by Jeff Bezos, is an AI search engine startup that has recently drawn a lot of interest from users and investors. Their main advantage for me lays in the clear stating of sources, which helps users to dig further into articles. I actually use this AI to gather information and sources for my master's thesis. Valuation. With this in mind, we are now assuming that Alphabet loses search market share over the next years, to then evaluate the company and see if an investment might still make sense. The digital advertising market is expected to grow at a compound annual growth rate of 15.4% from 2025 to 2030. As can be seen here, Google has already been losing market share in the digital advertising market over the last years. If the AI competitors also manage to take market share from Google, this trend should accelerate. For our worst-case scenario, we therefore assume that Alphabet is only managing to keep their services segment revenues constant at current levels. We also assume that Google is keeping its margins at current levels, as well as some kind of cost discipline in the other segment of the company to cap their losses in this segment at $10 billion each year. So even in this scenario, the company seems to be trading at the somewhat fair value range, as this DCF gives us a fair value market cap of $1.9 trillion. Regular scenario. If we now assume a very well achievable growth rate of 12% in the services segment, compared to the anticipated growth rate of 15% in the advertising market for the next years, Google, on the other hand, offers significant upside. Anticipating this growth, we get a fair value market cap of $3.25 trillion, indicating a potential upside of up to 61%. Alphabet is actively trying to maintain their dominance in online search and digital advertisement through various strategies. Google is creating its own AI products to combat the danger presented by new AI search engines. Notably, in an effort to improve user experience and hold on to its clientele, the business unveiled the Gemini AI assistant, which is embedded into Pixel 9 devices, for example. Google could also implement their assistant into more and more Android applications, capitalizing from their already existing user base. Due to the vast infrastructure, capacity, and amount of data, Google has a competitive edge over new AI rivals when it comes to large amounts of inquiries and to the training of models. Because of its enormous scale, Google can effectively handle and analyze massive volumes of data. The company should also be able to roll out new products more effectively through the already widespread Google search. Using their high amount of user behavior data, possible optimizations and development in the customer-centric products are also easier for Google. Conclusion. Given these developments and initiatives, I believe that Alphabet is very well equipped to tackle the AI search engine competition. Thus, assuming no growth rate for the whole services segment seems unreasonable, especially when also factoring in YouTube's success. According to our two DCFs, this translates to an undervaluation of Google ranging from approximately 0% at no growth in the services segment and approximately 60% at 12% growth. That's why I currently rate the company a strong buy with a medium price target of $210.